Good morning. This is our second class on a syllabus drugstore and business management. Our today's discussion topics is balance sheet, which is included in a syllabus of drugstore business management in unit 6, and this is important for DPharm second year students. Now, balance sheet. A balance sheet is a financial statement that reports a company's asset, liabilities, and shareholders' equity at a specific point in time and provides a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. It is used alongside other important financial statements such as the income statement and statement of cash flow in conducting fundamentals analysis or calculating financial ratio. Now, the formula used for balance sheet. The balance sheet adheres to the following accounting equation where asset on one side and liabilities plus shareholders equity on the other side. Now the equation is asset equal to liabilities plus shareholders equity. Now the balance sheet is a snapshot representing the state of a company's finance at a moment in time. By itself, it cannot give a sense of the trend that are playing out over a long period. For this reason, the balance sheet should be compared with those of a previous period. It should also be compared with those of the other business in the same industry, since different industry have unique approaches to financing. A number of ratios can be derived from the balance sheet, helping investors get a sense of how healthy a company is. This includes the debit to equity ratio and the acid test ratio, along with many others. The income statement and statement of cash flow also provide valuable context for assessing a company's finance, as do any notes or addendas in an earning report that might refer back to the balance sheet. Now, asset. What is asset? Assets are divided into two segments. Number one is current asset and second is long-term asset. Now, current asset. Current assets are classified into 5 groups. Cash and cash equivalent. Cash and cash equivalent are the most liquid assets and can include treasury bills and short-term certificates of deposits, as well as hard currency. Second, marketable securities. Marketable securities are equity and debit security for which there is a liquid market. Third, account receivable. Account receivable after true money that customer owes the companies, perhaps including an allowance for doubtful accounts, since a certain proportion of customer can be expected not to pay. Fourth, inventory. Inventory is goods available for sale, valuable at the lower of the cost or market price. Fifth, prepaid expenses. Prepaid expenses represents the value that has already been paid for, such as insurance, advertising, contracts, or rent. Now, the second is long-term asset. Long-term investments are securities that will not or cannot be liquidated in the next year. Fixed asset. Fixed assets include land, machineries, equipments, building, and other durables, generally capital intensive asset. And the third long-term asset is intangible asset. Intangible asset includes non-physical but still valuable asset such as intellectual property and goodwill. In general, intangible assets are only listed on the balance sheet if they are acquired rather than developed in-house. Now, liabilities. Liabilities are the money that a company owes to outside parties from bills it has to pay to suppliers, to interest on bonds it has issued to creditors, to rent, utilities, and salaries. Current liabilities are those that are due within 1 year and are listed in order of their due date. And the long-term liabilities are due at any point after 1 year. Then we came to know liabilities are classified into two steps: current liabilities and long-term liabilities. Current liabilities are current portion of long-term debit, interest payable, rent, tax, utilities, wages payable, customer prepayment, dividend fund payable, and others. And last, earned and unearned premiums. And the long-term liabilities also classified into three categories. First, long-term debit. In long-term debit, interest and principal on bonds issued. Pension fund liabilities, the money a company is required to pay into its employees' retirement account. And third, deferred tax liabilities, taxes that have been accrued but not will be paid for another year. In our today's topics, we came to know about balance sheet, and on that chapter we came to know about balance sheet and asset and liabilities. Thank you.